Hello, this is Mike Doyle with the Mortgage Firm, and it is Wednesday at noon, so we are doing our Facebook Live. We're here every Wednesday at noon, and we're here to answer whatever mortgage-related questions you may have. So we tell everybody, grab your lunch and bring your questions with us, and we'll cover different topics. Today's topic is going to be pre-approvals, the importance of pre-approvals, and why our pre-approvals are better than other people's pre-approvals. So as always, I've got Tom Bennick with me. Tom's been in this industry forever, over 20 years. He was back in the broker world, in the banking world, and he's been last 7 years or so with the mortgage firm, right?
Yeah, going on 8 years.
Yeah, Tom is old school customer service. He'll meet customers at their houses. He'll go to the banks, help them print out bank statements, whatever it takes. So Tom's very knowledgeable and very patient. Does a great job with all the customers.
No, good. Thanks for the intro.
Okay, so we'll cover a little bit. Let's start a little bit on pre-qualification versus pre-approval, because we see pre-qualifications everywhere. People think they've been pre-qualified. They've never spoken to anybody or given anything out. So Tom, what's the difference between the two?
Well, I think a pre-qualification, if I have it right, is somewhere where someone would come to me and basically verbally let me know where their situation is. They're not necessarily ready for me to pour credit. They're kind of telling me what their what their 2-year history is regarding their income, their assets, and things like that. And I can get them what's called a pre-qualification letter. I don't know if it necessarily is something that you would want to make an offer on, but it's just a quick little consultation. The pre-approval letter is an actual, I've pulled credit. We've seen your income documents, whether it be your tax returns, your bank statements. So the pre-approval will hold a lot more water than the pre-qualification. The pre-approval letter means we've kind of looked at all your income and all your other documentation. So you're ready to make an offer. Kind of sum it up.
Yeah. The pre-approval is kind of the borrower telling the seller what they can qualify for. The pre-qualification letter is kind of the borrower saying what they qualify for, and the pre-approval is us saying, what you can qualify for based off of the guidelines that are given to us. Because we deal with people all the time, and I like to have a conversation with somebody. So in the first couple of minutes, we just talk. So what are you making? I made $100,000 last year. All right, great. At $100,000, you qualify for a certain amount. Where did that money come from? Well, I sold a house and I made $50,000 there, and I sold some stock. I made $25,000 there, and then my regular job pays me $25,000 a year. Well, that's a whole different story. So the stock you have, maybe it's all gone. You sold all your stock. Your house you sold, that was the one house you own, and the $25,000 your business is your business, so that's your income. So it's a whole different picture. I had a guy give me 3 W-2s where he was making $120,000, and I'm like, that's great, you got 3 jobs. He said, nope, I had 3 different jobs. They each paid about $40,000 until I got fired, and now I'm down to 1 job that's paying me $40,000 a year. So we're not counting income that you don't have anymore. And a lot of times in capital gains, when you sell a house or you sell property, you sell something like that, often we can't count that. Now, if you've got a bunch of houses and you always sell a house or 2 every year, and that's what you pay yourself with, or you sell stocks every year, or you do anything you do consistently, I don't care what it is, if you do it consistently, and that's how your money comes in and we can track it, we can probably count it as income. But these one-offs just do not get counted.
No, a pretty good rule of thumb is, I think, what have you done in the past 2 years, and is it most likely going to continue for the next 3 years, at least the next 3 years? So, like Mike said, if you're selling houses, then I'm hoping you're showing us a proof that you were able to sell them for the last couple of years, and then you've got enough houses to sell for the next 3 years. So, yeah, that's the difference between the pre-qualification and the pre-approval. We're going to kind of break down where the income is coming from.
Right. Right.
And what we could use, part-time income, if it's less than 2 years, we sometimes can't use, we can't use part-time income if it's less than 2 years. So these are things that we kind of like, this is why we ask so many questions.
Yeah, everything Tom's dead on what we can count as far as income. Part-time income, if you've had a full-time job and a part-time job for 2 years, we'll count your full-time and your part-time. If you're getting overtime and you've been getting overtime for 2 years and it's continuing this year, we'll count your overtime. The same thing with bonus and commission income. So if you just got a brand new job that's paying you bonus and commission, if we don't have a history of bonus and commission income, we cannot count that. So a lot of times the income that you're making, you're seeing, is not the income that we can count when we run your approvals through Fannie and Freddie, FHA or VA. So one of the important things in this industry is your pre-approvals need to be good. So when you're handing a pre-approval to a realtor, and the realtor is referring their customers to you, so the realtors give us a customer and they want us to evaluate that customer. So we want to make sure that that customer is looked at. We pull all their income docs, assets, credit, everything. And when we issue that pre-approval, we need that loan to close because that's our reputation. For whatever reason, a large amount, I believe it's close to 40% of loans just do not close or do not close on time. And a lot of the pre-approvals we see are just horrible. So people are just basically, they're giving them a pre-approval when it really at most should be a pre-qual. So when we call that listing agent and we say we've evaluated this customer, they're good to go, we're going to close it, our reputation's on the line. We want to make sure that we get this closed, and we want to make sure that we keep our reputation intact.
Yeah, we've both experienced in the past where people might be shopping for mortgages or calling around asking for, consultations and stuff. And we'll ask them, what paperwork did you give the other lender that gave you this information? Well, I didn't give them any. Well, then how would they know how to calculate your numbers, what you can afford on paper and what you can't? So, and as we get into self-employed people, it can get even more challenging, convoluted, whatever you want to call it. Self-employed people have the option to write off expenses and things like that. So that too will make a big difference when it comes to getting either pre-qualified with the self-employed individual or pre-approved.
Yeah. Tom and I both spoke about this. We've been doing this for a long time. So the customers, when they're calling you, they may be calling you and they're calling 5 other lenders. So the other lenders, a lot of times, look, we all want to take care of the customers. We all want, the customers to be able to use us. But a lot of times, if you're a young lender or you're new in this business, you don't want to deliver bad news to the customers, and we don't see it as delivering bad news. We just see it as delivering them the information that, is valuable. So often we'll run into other lenders that they don't want to let them know your credit's not good. I can't count this. I can't. So they don't want to tell the customer, things that will make the customer unhappy, to where after years, we know what we can count, what we can't count. We just don't want to waste the customer's time and want to be honest with them. So when they come to us, we just give them an honest assessment of what we can do. In any of the gray areas, we run it by the underwriters. And we're always trying to sell it. We're here to close loans. So, we want to put the best foot forward, present it to the underwriter, make sure, what they're getting is the full story, and then if they can do it, we want to go ahead and get the loan closed. But more often than not, the people that are painting the rosy picture to the customer, they might get that loan first, and then the loans fall apart. They come back to us. And a lot of the loans that fall apart that come back to us are loans that just really were not structured correctly. There were just different things that could have been done to get the loan done, but the lender, just didn't know what angles to take.
Mike and I have been doing this for 25 years plus, and we both did several years at the bank. And we both agree, I think we would rather call you and ask you for updated income documentation or stuff we might need to make your numbers right, rather than call you on the day of closing or the day before and saying we're not closing, which regretfully we both kind of experienced when we were working in the banking world. So these are things that, of course, we pick up the phone, you make the call, you get what you need, and you move forward.
And I will say, there's a couple ways. When you give out that pre-approval, once that contract comes in, then the digging starts. We run a fraud guard. We start looking at everything. So you start digging into businesses, you start finding more problems, you start finding a property somebody had. Maybe there was a short sale or foreclosure started, something that wasn't brought up in the application process. But, we look at it as though our reputation is on the line. So, we're trying to find out what we can do to get these loans closed. I say sometimes your ego has to bail out your IQ and sometimes vice versa. But if you're giving out those pre-approvals, you want to make sure that you're getting your loans closed. Now, occasionally, somebody, they just don't disclose something that we can't see up front. So if they're hiding it from us and it comes up in the process, it's a lot harder to work around. So we want to make sure that all the customers know, tell us what's going on. Tell us the whole story. Because if we know the whole story, we can explain the story. So if there's a good explanation on certain things, when we present it to the underwriters, and they're going within the guidelines of Fannie and Freddie, but if we present it to them and it makes sense, it's a lot more likely than if it looks like something was being hidden. So we don't want anything to be hidden. We want everything to be clear and upfront so we can, explain it. So right now, what I'm going to do is, and one key thing is, we don't approve you for a loan, because somebody can say, hey, I've been approved for $500,000. You're never approved for a purchase price. You're approved for a payment. So that $500,000 house, if you have high taxes, high insurance, high HOA, you could qualify for a $600,000 house if you have low taxes, low insurance, and low HOA. So sometimes we'll give out a pre-approval. Somebody says, I want to be out in the acreage where there's no HOA, and we give them a $400,000 pre-approval. Next thing we know, they're making an offer on a house in town in an HOA with a guard gate and a $600 a month HOA, and it's for $450,000. So I gave them a $500,000 pre-approval, and they do a $450,000 contract, but they don't qualify because they got a $600 HOA. So we're going to pull in a program that we use called StreamYard, and hopefully you can see it. And we're just going to fill out it. And this transfers over when we take the application, but we're going to fill this out a little bit here. So we're just going to do Michael Buyer. We're going to do Michael Home Buyer. And then the email, we'll just do mine. Let's just do hopefully they like my thing. We'll do 8461 Lake Worth Road. It's the office. Lake Worth, Florida 33467. All right. So let's go back to that 500,000. 500, 1, 2, 3 annual taxes. And the key on the annual taxes is we're going to qualify you based on where the taxes are right now. So you buy a $500,000 house and somebody's been in there for 20 years and the taxes are $2,000 a year. We know they're not going to be $2,000 a year when the house is reassessed. So by the time they assess it, you buy a $500,000 house, they assess you at $450,000, $50,000 homestead exemption. You're being taxed on, $400,000. You're looking at probably about an $8,000 tax bill or so. I tell people, like, do 1.5% just to kind of do a ballpark, but we'll do $8,000 right here. Homeowners insurance, boy, that's a tough one. We used to estimate these really lower, but
good luck answering that one.
Oh my gosh, these ones here will kill you. And then the HOA, figuring where they're going to buy, we'll throw in an HOA, but let's just say 150. So you got a fountain and some lights, and then we'll do a state will be Florida, county will be Palm Beach. Okay, primary residence. And then we come in, we'll do a 30 year in months. We got 360. And then we got qualification. Now I use 6%. Now 6% is going to be low now unless you're doing bond. But 6% is the magic number. 6% interest rate is a magic number because your monthly payment is $6 for every $1,000 you borrow. So if you get a $100,000 loan, 30-year fixed at a 6% interest rate, your payment per month is $600 principal and interest. If you get a $400,000 loan, your payment is going to be $400 times $6, which is going to be $2,400 a month. All right. So I like to use 6 just because. All right. Down payment percent, we're going to go ahead and say 5%, $25,000, and our loan amount is $475. Okay. And then we come in here, it's probably going to be a single family, and we're looking at mortgage insurance defaults and then discount points. It's hard in this day to not be paying one discount point. Seller concessions. And then here, this is the most important one. We set the parameters. This is where we set the parameters. We look and we say, all right, you can afford $5,000 a month. Okay. How much money do you have? You can afford, let's say you got $55,000. So you got $55,000, and then we have any other contingencies, anything like that? No. So we come in and we save it. Okay. But from here, we got the information in there. Now we send out the PDFs. So here we have approved the PDF, and you can see right here, this is your pre-approval. So your pre-approval on this one here, that's going to go out to you. It's going to go out to the listing agent, the buyer's agent, whoever wants it. They go ahead and they get their pre-approval. And we keep it all within our lender logic system, so our customers can get in, our realtors can get in, and they can go ahead and send out different pre-approvals based off of the parameters that we put in. So I know, and I know everybody has a different system of doing it. So I have one realtor that if the customer qualifies for $1 million, he wants $1 million pre-approval. And he says, I don't care if we're making a $250,000 offer. I want that seller to know my customer could buy $1 million and we're going to pay what I tell them we're going to pay. I have other realtors that say you're tipping your hand when you tell them that. So if we're doing a $501,000 offer, they want a $501,000 pre-approval. And then they go make a $502,000 offer. They want a $502,000 pre-approval. Well, which is fine. Whatever the realtor wants and that makes them comfortable with, we want to do it. But if it's a Sunday afternoon and I'm out doing something, I can't always be putting out 20 different pre-approvals as they keep changing the offers around. So this system allows us to set the parameters up, and then they go in and they print out their own pre-approvals within our parameters.
And this way, when you're out looking to make offers on places over the weekend, and for some reason we're not available, whether it's a Sunday, whatever the case is, your realtor and yourself has the ability to go in and create your own pre-approval letter, based on the parameters that we put in there as the limit. So it's a great program to have access to.
Yeah. So on this one here, you can go in, you can take a look at it. Like right here, we're looking at the basics. $500,000, $25,000 down, 5%. And it just lays out property taxes, HOA, and all the things that you're going to run into. So you can see that the monthly payments, $42.74. So from here, you issue the pre-qualification letter. The customer can do that. The realtor can do that. Well, let's say they go ahead and they're like, geez, we like this house, $510,000. And you know what? Maybe we want to put 10% down. So we'll put 10% down. Okay. But wow, this one here, the property taxes on this one are $10,000. Okay. Monthly HOA fees are a little bit more. They're $300 a month. Okay. So now you can see down here, I ended up with red, maximum cash to close, $55,000. So they cannot issue a pre-approval because they're outside of the parameters. So they come back up here and they're like, all right, let's see if we can do 5% down. So at 5% down, they are within their limits. So they can go ahead and issue a pre-qualification letter. So the customers like it because they can get in here, they can play with all the numbers, see what everything looks like, adjust it, and then go ahead and issue their they can go ahead and issue their pre-approval letters. So it's a great system. And for realtors, they can see all the pre-approval letters that they have and all the customers that that they have within there. And we can also see when the customer gets in there and starts playing with the numbers a little bit. So it's nice to see if you did a pre-approval for a customer months ago, and now they're in there looking at the pre-approval, we know that they're back thinking about it. We can reach out and see if they need any help.
Yeah, it lets us notify when somebody goes in and starts adjusting some of their numbers, just in case we need to maybe update their numbers. Maybe they got a raise, maybe they got some additional income, maybe they have a co-borrower that joined. So this way we can go in and make adjustments to it.
Yeah. And on this one here, it's really nice as far as laying things out, like prepaids and escrows. If we click on prepaids and escrows, you can see that this is what we were estimating insurance at, $4,500. This is what taxes were, and this is what the daily interest was. And again, when we're looking at closing costs, a lot of times, some of the things that we run into is I'll get stuff from another lender, and the customer will be, how come their closing costs are $5,000 less than yours? I mean, they can't be $5,000 less. Our lender fees are $1,000 and some others. But the insurance is, I'll see insurance of $1,500 on a $500,000 house. I'll see taxes of $2,000 on a $500,000 house. Or daily interest, they all have the house closing the last day of the month. So the daily interest is $20. So there's a lot of things that are completely out of our control. Also the title fees. In Palm Beach County, the seller chooses the title company. So there's a lot of title fees that, are based on nothing that the buyer can do. So I see estimates all the time that are just awful. And it comes back to the fact too that, the lenders often just want to tell the story that looks good for the customer. And then by the time it comes to lock and pay for everything, there's always some excuse why they couldn't deliver it. So we just want to make sure that, we even have a little cushion. So in our example here, if this customer, we're telling them $47,505 cash to close, I'd be pretty upset if it was 40, if it was anything over 47,000. I would expect it to be probably under $46,000, because we like to have a little cushion in there, because every now and then something pops up that was unforeseen. So.
And speaking of things popping up that are unforeseen, what a great segue into Florida's homeowners insurance. So now when we have borrowers and we go through numbers in a quick consultation, and I've got one now that just got their inspection report done, we are aggressively shopping for insurance. I mean, that's one of the first things now we're looking to do, is get an idea on how much your homeowners insurance is going to be.
Yeah. Boy, when you're out there, I mean, I just ran into one right now where the the trusses aren't scrapped. They just had the nails in them. And you can be talking a lot of money. Polybutyl piping.
Polybutylene piping, if nobody knows what that is, or for people out there not familiar with that, what was it, 20 years ago, maybe?
Yeah, it was back with the drywall that had the issues in it. But
there was polybutylene pipe, I think, that was made out of, you'll probably know better being an engineer there, gasoline or something, whatever it was made out of. They did find out it was made out of the fittings wouldn't support the test of time, and what would happen is they would bust. Apparently
they're delicious to rats and mice, and they say that rodents would chew on them. But if you had polybutylene piping, there was a good chance that you're going to have a big leak. There was a big article, Tom. I think you sent me that article, and it was about people being frustrated that they couldn't insure, and they felt that they had a right to get insurance, but the insurance agent, if he knows he's looking at a $20,000, $30,000, $40,000, $50,000 claim, we had one. I think Elizabeth had one that the insurance quote was $9,000, $10,000 for the piping. And it's because they know that if they issue, 100 policies on that there's a good number that will end up having big claims. And the water, a lot of times it isn't one that you can just, if you're walking across and you spill some paint on your floor, you're just fixing it. You don't want to call your agent because you're probably going to get dropped. But when you get a flood and you're not there and the whole house is flooded, that's big money. And a lot of times there's just nothing you can do about it. You've got to reach out to the insurance agent for help. So, yeah, it's very difficult if that's the case.
Yeah, it was supposed to be a product that was a lot less expensive than PVC, a lot easier to work with because it's flexible and bendable. But of course, it turned out to be defective. So that's why it's impossible to get insurance with polybutylene pipes, or at a tremendous cost. Then you might have to go through the cost of replacing those and then get your insurance readjusted now that you've got new pipes in the house. So. And they are hard to look at. You can look underneath the sink and think you see polybutylene, and you might see the white PVC pipe, but who knows what's behind that wall there? And so that's where it gets a little bit challenging.
Yeah. The retrofit. I think we just had a retrofit on about a 22,000 square foot house was about $7,000, $8,000. So you're right. It depends on. I mean, if you got a concrete floor, a concrete slab, I think sometimes they'll go up through the attic to, get everything working. But if you got to go and start cutting through concrete, it can start getting very expensive. And like Tom had said, sometimes you'll see that gets replaced on the part that the inspector might not see. So they'll do a little replacement into the wall, but the parts that are running inside the wall might be the old stuff. So that's something that's almost worse, because the new home buyer doesn't always get the opportunity to see what's really in there.
And in the event that you do have a busted pipe, is that your homeowner's insurance that covers it? And I think it would be, or is it flood? Do you need flood insurance? Yeah. I think flood insurance only comes into play if other houses around the neighborhood are flooding. But, insurance companies certainly know how to do a very good dance when you come to put in a claim. So, it's I think it's homeowners, but either way, that's why insurance companies won't insure poly pipe. And the other thing that's coming up now, is we're noticing, is roofs. A roof. How long is your roof life expectancy for? And that's becoming a bit of a challenge. Let alone something else I heard, and not to ramble, but now insurance companies are questioning and considering solar panels on top of your roof. Well, okay, so what kind of effect is that going to have on your roof? And do we want to insure a house that's got solar panels that has a roof that's either holding the panels or might be whatever it's doing to affect the validity of the roof? Who the heck knows?
Now, of course, we have some amazing insurance companies that we've worked with for many years. So for for Rob Crane and Brian Murphy may be listening here. We absolutely love them, and they do a great job.
That's why
But
we go.
it's just these things that do come up and they become a problem. But Florida has had a lot as far as roof goes. There's been a lot of claims and a lot of lawsuits, and you'll have some storm, a named storm or something that comes in, and then you'll have the adjusters will go ahead and identify damage to the roof, and these roofs are getting replaced fully. So you can have a 30-year-old roof, and damage is identified, and a $30,000 claim is put in for a brand new roof. So that's where the insurance companies are getting a little bit more hesitant to insure these old houses. I know, like I said, once your roof becomes 25, 30 years old, when a hurricane hits, I was kind of lucky. I bought my house and the hurricanes hit within 3 months, and I did have significant roof damage, and I got a new roof, and my roof was probably 20 years old at the time. But yeah, I felt lucky to be able to get reimbursed for the roof. And I think that the insurance companies, obviously they know that. I mean, if it's coming time for you need a new $35,000 roof, it's always nice to get a free $35,000 roof instead of paying for it out of your pocket. So.
And this all comes back to getting your pre-approval numbers right, because if we're kind of anticipating, let's say $2,500, $3,000, well, $3,000, $3,500 a year for insurance, when it comes back at 6 or 7, that's going to adjust your numbers. So that's why we just want to be sure we get those insurance quotes out as soon as we get the inspection reports back.
Yeah. Now, also we want to touch base. We don't have Elizabeth with us today. Elizabeth is out for the day. Her daughter Mia has spring break, so she's running around doing a bunch of fun stuff with her today. So Elizabeth will be back next week, and we'll have some other good topics to cover. What else good do we have going on, Tom?
Well, there has been, regretfully, a little bit of, you might have heard on the news, Silicon Valley Bank, SVB Bank, I think, and there's another bank that was closed. So that is actually affecting interest rates. Luckily, interest rates, if you want to pull up the 10-year, I know you're on top of whatever, but interest rates have come down a little bit since last week because of what's going on in the banking world. And I think all over the news today is Credit Suisse that is having a little bit of an issue keeping their doors open. And you could see, look at that, right on cue. Look at the drop in the 10-year. I mean, as of Friday, it was over 4, or it was touching above 4. There we go.
4.07, yeah.
There we go. As of Friday. So that's what's taken. That's why there's no crystal ball to determine what's going to happen, Tom. What do you think is going to happen with rates? Clueless, because things like this happen out of the ordinary that nobody knows about, and it affects the market. So this is what's going on with the 10-year right now.
Yeah, we were projecting them to trend down a little bit through here. So we were kind of expecting a little bit of this here, but nobody knew what was happening to Silicon Valley Bank. I mean, that was something that just came out unexpectedly, and then we didn't really know. It looked like everything was under control. So there was a little bounce back yesterday as they felt everything was under control. Well, now it looks like there's some other banks that are having some issues. So they're starting to look a little bit at some of the other banks. So now there's a little bit of concern. So the difficult thing in our world is, as the economy is struggling, it's good for the 30-year rates. So as people are looking at, trying to get inflation under control, they're trying to slow the economy down. But as the indicators keep coming back and saying, oh, the economy still looks good, it means that the 30-year rates are probably still going to be higher. So there is a little bit of things being kicked around right now, like are the Feds going to raise rates again? And they were talking about a 0.25 to a 0.25 to 0.5 jump. And now they're looking at maybe a 0 to 0.25 potential jump coming up next. So they don't really know. But there's a lot of things going on with that. And I do say this, those guys are brilliant. That is a hard job, because you got a lot of, doesn't matter what you do, you are affecting somebody, in a bad way. And you're helping out somebody else in a good way. So there's no right answer for those guys.
No, it's certainly not easy trying to balance the economy, but it's because of what has taken place. It does, fortunately, interest rates now seem to be trending down a little bit, whereas Mike was saying they were trending up as of last Friday. Maybe we're expecting a 0.5 point to 3/4 of a point increase going into, I think they're meeting next week or the end of this week, but now they're more on either pausing hopefully or going to a 1/4 point increase if that takes place. So we'll know.
Okay. All right. Well, look, we are here every week. So love to see you. Like our page, share our page, add comments, bring your own questions.
Mm-hmm.
Hop in and join us. And hopefully we'll see you next week. Have a great week.
Thanks.